What if you could profit from natural disasters without causing them? That's the premise behind catastrophe bonds. And for institutional investors, they've become one of the most unusual and lucrative instruments in the fixed income universe. A catastrophe bond is a high-yield debt instrument designed to transfer risk from an insurance company to the capital markets. Here's how it works. An insurer, say, a major reinsurer, faces potential losses from events like hurricanes or earthquakes. Instead of holding that risk on their own balance sheet, they create a special purpose vehicle, an SPV. The SPV issues bonds to investors. Investors receive a coupon, typically well above market rates. If no catastrophe occurs before maturity, investors get their principal back in full. But if a specified trigger event happens, a Category 5 hurricane, a magnitude 7 earthquake, the principal is partially or fully lost, and the money flows to cover the insurer's losses. The risk is real, and so is the return. Let's get into the mechanics. The most important variable in a cat bond is the trigger. Three main types. Indemnity triggers pay out based on the issuer's actual losses, closest to traditional insurance but hardest to model quickly. Parametric triggers fire based on a physical measurement, wind speed at a weather station, earthquake magnitude on the Richter scale. Faster settlement, less moral hazard. Industry loss triggers use an index of total insured losses across the whole sector. Inside the SPV, investor capital is held in a collateral account, typically invested in money market funds, so it's not sitting idle. The coupon paid to investors comes from two sources: the risk premium from the insurer, plus the return on that collateral. That's why yields look so attractive. And the timeline is simple. Quarterly coupons for the bond term, usually 3 years. No event, full principal back. Major event, principal gone. So why would a serious investor want exposure to hurricane risk? 5 reasons. First, zero beta. Cat bonds are almost entirely uncorrelated to equity markets. When the S&P 500 crashed in 2008, cat bond spreads barely moved, because earthquakes don't care about Lehman Brothers. Second, the yield. Historically, 6 to 10% above the risk-free rate. That's high-yield territory with a different risk profile. Third, genuine diversification. Insurance-linked securities are their own asset class. They add something most portfolios genuinely lack. Fourth, structure clarity. You know the trigger, the maturity, the payment schedule. No covenant games, no earnings surprises. Fifth, the market is growing. Over $45 billion in outstanding issuances as of 2024, up from almost nothing in the 90s. Now the other side. Risk 1. Total loss. If the trigger fires, you don't get a haircut, you get wiped out. The principal pays the insurer. This is not a write-down, it's an obliteration. Risk 2. Illiquidity. There is no liquid secondary market for most cat bonds. If you need out before maturity, you may not find a buyer at any reasonable price. Risk 3. Model risk. Cat bonds price off catastrophe models, RMS, worldwide. These models failed to fully anticipate Hurricane Katrina's flooding. If the model is wrong, the spread is wrong. Risk 4. Climate change. Every historical loss distribution was built on a world that was slightly cooler. The frequency and severity of tail events is shifting. Whether spreads are compensating for that is an open question. Let's look at what the numbers actually say. The Swiss Re Global Cat Bond Performance Index has returned approximately 7.5% annualized from 2002 through 2024. For context, high-yield corporate bonds returned about 6.1% over the same period, with significantly higher correlation to economic cycles. Equities returned more, but with gut-wrenching drawdowns. Now look at 2008, the financial crisis. S&P 500 down nearly 40%. Cat bond index, essentially flat, because no major hurricane struck that year. Zero correlation to the credit crisis. After major events, spreads widen. meaning new issuances come at even better yields. After Hurricane Katrina in 2005, spreads spiked 350 basis points. Investors who bought into that widening were well compensated as risk repriced. The pattern repeats. Disaster strikes. Spreads widen. Patient capital earns outsized returns. Who's on each side of the trade? On the issuer side, you have major global reinsurers, Munich Re, Swiss Re, Hannover Re using cat bonds to manage their own peak risk accumulations. Governments issue them too. FEMA has used cat bonds for US flood risk. The World Bank issued pandemic cat bonds. On the investor side, specialist insurance-linked securities funds like Nephila Capital and LGTILS Partners dominate. Pension funds are increasingly active, seeking yield they can't find in traditional bonds. Hedge funds provide liquidity and opportunistic capital after spread widening events. The market has grown from essentially zero in the mid-90s to over $45 billion in outstanding issuances today. It is niche, but it is maturing. So where does this leave us? Catastrophe bonds are a genuine financial innovation, a mechanism that converts insurance risk into capital market securities. For investors, uncorrelated returns, attractive spreads, structured clarity. For issuers, risk transfer without traditional reinsurance constraints. The risks are binary and real. Total principal loss is not a hypothetical. Climate change adds uncertainty that historical models may not capture. But for sophisticated investors seeking genuine diversification, catastrophe bonds are one of the few instruments that genuinely delivers it. If this breakdown was useful, subscribe for more alternative finance deep dives. Next up, contingent convertibles, the bank bonds that turn into equity when things go wrong.